All right, Yield Nerds, episode 178. And now I am a changed man. I am into algorithmic trading while the bond market is asleep. Now, why do I think the bond market is asleep? I will tell you more in just a few minutes. Before we go too far, 491 subscribers. Thank you for your support. If you're new to the show, please use the Income Investing Roadmap, which talks about fixed income investing from a beginner's perspective, and of late, more about equity investing. We also have a couple of additional playlists, and you will see what they are when you take a look at them. My main disclaimer, I am no expert. I do not have magical powers of prediction, so make sure you do your own homework before you go further. Well, four parts today. The first is the market temperature, and I'll compare my returns with that of the market. Some days are good and others are not. And then we'll look at the yield curve and why do I believe the market is asleep? And here I am meditating in front of the New York Stock Exchange with all these municipalities and school systems and bridges and roads. And algorithmic trading is my new exciting area that I'm looking at a couple of possibilities. And I'll tell you more about what I'm doing there and I'll share my holdings, the result of algorithmic trading. Well, my bond portfolio is barely up by 0.5% in the month of September. And the reason I focus on the month of September is because, as you know, the last FOMC meeting had that quarter point, and my portfolio started waking up and going nuts at the beginning of September in anticipation of a huge cut. And the cut indeed did happen, as you know, but it was only a quarter point. And after that, it has kind of gone to sleep, as I would like to say. Thankfully, I did not take any risky bets thinking somehow that there is going to be this kumbaya of a 1% drop or a 2% drop. I didn't do any of that. And so my portfolio itself kept going up, and we'll compare it with the benchmarks and see how I did. Speaking of the benchmarks, the two benchmarks that I like to look at in the bond market, one is the Bloomberg US credit market, and the second is the aggregate bond market. And as you can tell, both of them bet a little too much. They got a little too excited about the possibility of a big cut, and after the quarter point cut, and the essential message that, hey, we're not going to be irrationally exuberant on cuts. We're going to have to take data into account. The bond market kind of went back and clawed a little hole underneath while I gently keep going up. Well, what about my equity portfolio? I continue to keep pace with the NASDAQ, my 3 month returns being north of 11%. And my last month, I've started working on my algorithm. And I got news, my algorithm took down my equity holdings. The dates are wrong, my absolute apologies. This is 2 weeks ago when I had 4.14% in equities, and this is as of today, and I'm down to 3.90%. And why did the algorithm recommend all of these cells and what was driving it behind the scenes? I'll tell you more. Before I go too far, I want to make sure you understand that I do not bet the farm on algorithms and equities and growth. I am very much a fixed income investor. I have a rock solid 20% in munis right now. All of them are investment grade. I have give or take 10% in agency bonds and 60%, 57% on treasuries, and a full 96% of my portfolio is in fixed income. So all of my algorithmic trading and equity experiments are on a minuscule portion of it. And as you saw, the algorithm I did create is already making me sell. And so I'll tell you more. Let's first focus on the yield curve with my municipalities and why the yield curve of late is sleeping. Before I go further, I want to make sure you know that I am not a wealth management advisor. This is not investment advice, and I'm not sponsored by anybody, and I don't do product or politics. Well, let's get to the meat of it. The yield cup, as I call it, we saw the middle of the yield curve absolutely crash in August. And once it crashed in August, it never returned. Note that even in August, the 10-year was at around 4.2%. And what happened after August when we looked at it in September, the 10-year dropped below 4%. And everybody was like, oh my God, the yield curve is crashing. and the entire yield curve has dug a trench. And if you were to take it at face value, you would say, well, if yields are dropping across the board, then we should increase duration, grab some of the higher yield before it goes even lower. Well, my strategy, as you may remember, was not to rush and buy all kinds of 10-year treasuries. My strategy was to buy munis, where volatility is very low, they are tax advantaged, and I always try to beat the treasury on a pre-tax basis by a healthy amount, and that is the way I think about it. And I initially wanted to buy a bunch of equities, but if I create an algorithm, I'm going to listen to it, and it started making me sell more than buy. And there is something very interesting happening. The bond market is telling us something. Just the last 2 weeks after the interest rate cut, you would think after the interest rate cut, long-term yields would go down. Instead, short-term yields are going down while long-term yields are going up. This is what we call bear steepening, with a fancy word to say, my. Don't jump and increase duration, because had you increased duration, you would have lost something like 5-7% of your face value, for the simple reason that the new yield is 4.2% back to May of this year, which is very interesting to me. May of this year, there was no talk of decreasing interest rates. Now we have done one, and the market still says, I worry, I don't think you can keep decreasing rates. And if you keep decreasing rates, I worry you're going to stoke inflation. If you stoke inflation, then you have to borrow more. If you borrow more, long-term interest rates will go up. That is what the market is trying to say. Now, the government is doing something a little bit interesting, I will say. They are borrowing in the short term and paying off long-term debt. Now, why would you do that? The reason you would do that is because long-term debt is at a very high coupon. The government, the treasury, controls the short-term debt. And so they figure if you keep dropping the short-term debt, then you can issue more short-term and take away more of the supply in the long term. Imagine trying to fund your local sewage by borrowing money every 3 months. It's a little bit of a warped strategy, but we live in warped times, and there is this huge potential. Is the rate going to go down? How much is it going to go down? And so strange times calls for strange investment strategies, and the government is saying, I am going to get rid of my long-term debt, take that entire face value, issue it short-term at a lower value. And so the market is saying, I'm not sure that is a good idea, because eventually you're going to have this enormous amount of debt in the short term. You're going to issue a huge amount of that long term, and long term yields will go up. That is what the market is saying. So, my instinct when I see bear steepening is to freeze. That is why I call it the sleeping yield curve. The yield curve is not sleeping, but I am sleeping in terms of increasing my duration, because I just want to see how high the long term will go before I increase duration. And so, how about high growth equities? Instead of saying, yes, I want to buy, or no, I don't want to buy, I use an algorithm to tell me what to do. Now, what is this algorithm? It is informed, first of all, by fundamentals. There are many people who will say, I don't care about fundamentals, I'll just buy a stock and keep going up or down. Power to you. I don't do it. I look for two filters. One is I look for companies with low debt. Again, if we are in a situation where interest rates are dropping, you can borrow more money. However, if the unthinkable happens, if we enter a recession, companies with a high debt, whether or not the interest rate is low, they are going to have trouble. And so I look for companies that have low debt to equity ratio, whose revenue is growing fast, and who have a reasonable market cap. That is one filter. I also look for companies where the stock price is rising slower than the revenue. That is it. I look for these two filters. I create a list of equities. Some equities may belong to both, in which case I will create a unique list of those two. Ouster was one of them. I own their stock. And you may remember from the previous episode, you may want to watch it, where I followed the MACD of Ouster. And the concept here being, we look at the 12-day average, moving average, and the 26-day moving average, and that's the MACD line. Then we compare it to the 9-day average, which is the signal line, and we look for inflection points. I went through that very, very fast. Please listen to the previous episode if you're new and you need to kind of dive into it in greater detail. But the MACD would give buy and sell signals. Again, you have to do your own homework. And I would do eyeball arithmetic. And it got really painful because I would get 30, 40, 60 equities that match my filters. I could not possibly open every chart every day to look at the signals. And so I would not be able to, for example, notice that Ouster had a sell signal and I would sit on it and miss the opportunity. So I'm going to take a case study of this algorithm. We've developed it. It has been automated within reason, and I'll show you how it has been set up or how I've thought through it. What I'm trying to see is the last 3 days compared to the histogram, and say if the histogram in the last 3 days is vastly different than the previous 27 days. Now, what is the histogram? The histogram is MACD minus signal. And so if the MACD and the signal are doing a crossover, before the crossover happens, this is what we are measuring. Are the last 3 days moving faster than some slow convergence? If the last 3 days are moving faster than the previous 27 days, then we create an exponential average of the last 27 days, compare the last 3 days to the last 27 days, and ask the wonderful question, is the MACD greater than the signal? This has been created and converted into an algorithm. The algorithm then spits out, here is Arch Capital Group, ACGL, something funny is happening in Arch, and that is what the algorithm is listening for. You can see that the MACD starts from a big negative number, minus 5.8, and it is slowly increasing, meaning the negative number is decreasing. The signal starts from a small negative number and it's digging a deeper trench. So the signal is going this way, MACD is going that way. They haven't yet crossed paths. And so what we are looking for is, are the last 3 days different than the previous 27 days? And when you look at all of that, it says, hey, the last 3 days are indeed different than the previous 27 days. This at the moment is still a sell, mainly because the MACD is less than the signal. However, here is what is happening underneath the covers. You can see that the MACD is racing upwards. The signal is racing downwards. The moment the MACD goes above the signal, the algorithm is going to tell me to buy Arch Capital Group. Is that the right move? Is that not the right move? You decide. I will follow my algorithm, but that is what we are trying to detect. Now, here is the danger in doing something like this. The danger is you can buy using an algorithm. You can make 5% on the first day, another percent on the second day, and so on. But what goes up may also come down. And so if you have locked in a certain amount of gains, you want to keep the gains. If you have a certain amount of losses, you don't want to dig a deeper trench. So what you are looking to do is, in the long run, you are trying to make sure that your gains are far higher than your losses. So one of the things I do every day, and I'll talk about how the algorithm is maintained and the next step of automation, I would sit up and say, okay, Hecla Mining went up by $4 today. I'm just using a simple example. And if the stock is presently trading at 18 or 14 or whatever it may be, I may say, I want to lock in my gains, and therefore I'm going to put a stop at $10.20. If Hecla comes down and the algorithm says sell, I don't want to go there and push another button. I just want it to automatically sell. That ensures that my minimum gains are protected and my bottom losses, my maximum losses are kept. And this is something I do all the time. I have many stop limits. This is very painful for me. So one of the things I'm going to do is see if I can automate this as well. So what does it do? You can see that I went from an infrequent trader to the algorithm is giving me bigger green circles because my gains are bigger. My red circles are there, some of them big, some of them small, but at large, I am up 10.6%. I'm happy with that. So as the losses get bigger, my automatic trades, my stop limits get rid of them. As the gains get bigger, I increase the stop limit to ever make a higher and higher number. And if something goes up, when it starts coming down, the stop limit caps my gain and I register the gain. So here is the limitation of the algorithm. I've reviewed some of it before. It's great to detect buy and sell points. Remember, we are measuring the last 3 days with the previous 27 days of the histogram. The histogram is the difference between the MACD and the signal. The MACD is 12 minus 26. So we can go through all of these again, but all we are saying is, are the last 3 days different than the previous 27 days in a 30-day window? And so I spend a lot of time maintaining stop limits every day. I'm going to try and see how to, decrease that pain with automation. I have to sit there and execute the buys on the strong buys and the buy signals every day. So I'm embarking on the next step of automation. I'm not yet ready to share the spreadsheet, but I did share the algorithm. As it goes to a point where I can say, possibly look at the filter and say, buy these, sell those, and it automatically works. I do intend to share the algorithm and the API. I just need to go there one step at a time. There is something that I'm struggling with, and if you have any thoughts, and if you're a MACD-based trader, I would love to hear your advice. When the MACD starts dropping, this is where my stop limits come into play. When the MACD stops dropping and it trends below the signal line, I would normally sell right about there when it drops below the signal line. Right now, the way the algorithm works is it'll say, well, MACD is still above the signal line. Don't sell even though you have negative histograms. So I'm trying to tweak it to understand what does this really mean. Should I sell at this point when the MACD starts dropping? Or should I wait until the MACD goes below the signal? I don't know the answer. Still researching, and time will tell. If you have any experience, I'd love to learn from you. So let me share my algorithm results. I am still pounding the living daylights of NASDAQ. Thank you so much. Here are my holdings. I shared my results with you earlier, but here are the individual holdings. Planet Labs is my superhero, followed by Rambus. But realize that every one of these that you see here have stop limits. And so if one or more of them crash by more than 15% or something like that on any given day, I will lock in my gains. For example, this is up 64%. If it falls 15%, then I would just clean up and get my 48%, whatever it is, gain. So I would always sell these at a gain. I have stop limit trades. And so these are page after page of gains. I do have some duds and blunders, but they also have stop limits. So if the 16 becomes a 19, UPS is my worst performing stock, but I have a stop limit there as well. So if UPS keeps climbing, I'll keep it. If it goes down below a number, I will dump it. This is how I think. You may think differently. Realize that only 4% of my portfolio is in equities, so it's easy for me to espouse values of some algorithm, but you need to do your own research and make your own decision. Thank you for watching, Yield.